Welcome to the Deep Dive. We're here to take complex information and really distill it down, giving you the insights you need.
That's the plan.
Today, we're diving into something almost everyone deals with, taxes. But specifically, we're looking at salaried employees.
Right, and we're comparing two huge economies, the United States and India.
It's fascinating how different they can be, even when taxing something as seemingly straightforward as a salary. We want to uncover the key differences, maybe some surprising similarities too.
Exactly. Our goal here is really to clarify this often confusing world for you, the salaried individual. We want you to understand the details, the implications of each system.
Whether you're dealing with the IRS in the US,
or the Income Tax Department under India's Income Tax Act, 1961, we've pulled together the crucial bits you need to know.
Okay, so let's start at the beginning, the basic setup. How do these countries even, administer their tax systems differently? What are the fundamentals?
Well, the core administrative structures are quite distinct. In the U.S., you've got the Internal Revenue Service, the IRS.
Everyone knows the IRS.
Right. And they operate under the Internal Revenue Code, their sort of rule book. In India, it's the Income Tax Department.
Okay.
And their guiding law is the Income Tax Act, which dates back to 1961, though it's obviously been amended many times.
And even the timing is different, right? The tax year.
Hugely different. The U.S. uses the standard calendar year, January 1st to December 31st. Simple enough.
Yeah.
India, however, uses a financial year. It runs from April 1st to March 31st of the next calendar year.
That must create some interesting situations for people moving between the two or working across borders.
Oh, absolutely. You have to mentally switch gears. Filing deadlines are naturally different too. The U.S. is typically April 15th.
Tax day.
Exactly. Yeah. Whereas India, for most salaried individuals, it's July 31st. It can be later, like October 31st if your accounts need auditing, but July is common.
So different timelines. Now, what about what actually counts as income? Is salary defined the same way?
Good question. Broadly similar, but the components can differ in how they're treated or reported. In the U.S., for a salaried person, taxable income generally includes your wages, any bonuses, commissions, and certain fringe benefits, things like company cars or maybe specific allowances.
And this is all reported on.
Your employer gives you a Form W-2 that summarizes everything, your earnings, the tax withheld. It's the key document.
Got it. And in India?
In India, the definition under salary can feel a bit wider. It includes your basic salary, of course, but also various allowances like house rent allowance, perquisites.
Perquisites, what are those exactly? Like benefits?
Yeah, non-cash benefits. Think company-provided accommodation, maybe a car, things like that. Also bonuses, gratuity, which is usually a lump sum paid at retirement or resignation after a certain period, and pensions.
And the form there?
Your employer provides Form 16. It serves a similar purpose to the W-2, detailing salary paid and tax deducted at source, TDS.
Okay, foundation laid. Admin, timing. What counts as income?
Yeah.
Now let's get to the heart of it. How is that income actually taxed? The rates, the brackets, or slabs in India. This is where it really impacts your take-home pay.
Exactly. This is the core calculation. Both the U.S. and India use progressive tax systems.
Meaning the more you earn, the higher the rate on, the higher portion of your income.
Precisely. But the specific rates and brackets or slabs are quite different. Let's take the U.S. first. For 2024, federal rates for a single filer start at 10% on the first chunk of income, up to about $11,600.
Okay, low starting rate.
Then it steps up 12%, 22%, and so on, eventually hitting a top federal rate of 37% for income over roughly $609,000.
But that's just federal, right? There's another layer.
Crucial point, yes. Most U.S. states also levy their own income tax. And these rates vary wildly, from 0% in states like Florida or Texas to over 13% in California at the high end. So your total tax rate in the U.S. really depends on where you live.
Okay, that adds complexity. How does India compare, especially with their recent tax regime options?
India introduced a choice, which is interesting. There's an old regime with more deductions, and a new regime, which is now the default, with lower rates but fewer deductions.
Let's focus on the new regime for FY 2024-25, as it's the default.
Okay. Under the new regime, for someone under 60, there's zero tax up to $3,000. That's the basic exemption.
About $3,600 US, roughly?
Yeah, roughly. Then it's 5% on income from $3 lakh up to $7 lakh. A key point here is a rebate makes income effectively tax-free up to 7 lakh under this new regime.
Oh, okay, that's important.
Then it goes to 10% up to 10 lakh, 15% up to 12 lakh, 20% up to 15 lakh, and finally 30% on income above $15,000.
So the top rate is 30%.
The top slab rate is 30%. But, and this is a big but for higher earners, India adds a surcharge on top of the tax if your income exceeds certain thresholds.
A tax on the tax.
Essentially, yes. And the surcharge rate itself increases with income. Plus, there's a 4% cess, basically an extra levy for health and education, calculated on the total tax plus surcharge.
Wow, so that 30% can become effectively much higher.
Oh yes. For the highest earners, the effective tax rate, all in, can approach nearly 43%, significantly higher than the top U.S. federal rate.
That 4% cess is interesting earmarked funding. Okay, different rates, different structures. But both systems have a standard deduction, right? How does that work? Is it similar?
They both have it, but it reflects that philosophical difference we keep seeing. In the U.S., the standard deduction is quite substantial. For 2024, it was $14,600 for single filers, double that for married filing jointly.
That's a decent chunk of income shielded from tax right off the bat.
It is. But the key is it's optional. You can take the standard deduction, or you can choose to itemize your deductions if you have enough eligible expenses like high medical bills, state and local taxes up to a limit, mortgage interest, charitable donations that add up to more than the standard amount.
So you do the math and pick the better option.
Exactly. It requires a bit more calculation, potentially. Now, India.
How does India handle it?
Simpler, in a way. For salaried individuals and pensioners under both the old and new regimes now, there's a flat standard deduction of $50,000.
About 600 US.
Roughly. And it's automatically applied. You don't choose, you just get it subtracted from your gross salary income. No calculation needed for this part.
So US, bigger amount, but optional required as choice. India, smaller amount, but automatic and simple for salaried folks. Clear difference.
Reflects that U.S. choice optimization versus India's structured benefit approach sometimes.
Beyond the standard deduction, this is where it gets really complex, right? The other deductions and exemptions. It feels like India, historically at least, had a lot more of these.
You're absolutely right. This is a major divergence point, especially if you compare it to India's old tax regime, although some deductions exist even in the new regime context, just fewer. Both countries use deductions to encourage certain behaviors, like saving for retirement or getting health insurance, but they go about it very differently.
Okay, let's break it down. How about retirement savings? Always a big one.
Right. In the USA, you have popular employer-sponsored plans like 401k. The contribution limits there are quite high. For 2024, it was $23,000 if you're under 50, plus potential employer matches.
That allows for significant tax-deferred savings.
Definitely. Plus, you have traditional IRAs with limits around $7,000. The focus seems to be on these structured, often employer-linked, high-limit vehicles.
And India.
India's approach, especially under the old regime, is more fragmented but broad, mainly under Section 80C of the Income Tax Act. This section provides a deduction up to a total limit of $1.5 lakh, about $1,800.
Lower limit than the U.S. 401k.
Much lower individual limit, yes.
Yeah.
But 80C covers a huge range of things. Employee Provident Fund, EPF, Public Provident Fund, PPF, life insurance premiums, certain mutual funds, ELSS, national savings certificates, even children's tuition fees, home loan principal repayment.
Wow, that's a mixed bag.
It really is. It encourages smaller savings across many areas. Plus, there's an additional deduction of $50,000 specifically for contributions to the National Pension System, NPS, under Section 80C CD 1B, over and above the 80C limit.
So, U.S. focuses on high-limit retirement accounts. India has a broader, lower-limit umbrella covering many savings types, plus a specific pension boost.
That's a good way to put it. Now think about medical expenses.
How do they compare there?
The U.S. has health savings accounts, HSAs, which are tax-advantaged accounts you can pair with high-deductible health plans. Contribution limits were around $4,150 for self-only coverage in 2024. Money goes in tax-free, grows tax-free, and comes out tax-free for qualified medical expenses. Very efficient if you use them.
Okay. Any other medical deductions?
You can deduct medical expenses that exceed 7.5% of your adjusted gross income, AGI, if you itemize. But honestly, that 7.5% threshold is quite high. Most people don't end up qualifying unless they have very significant medical costs relative to their income.
So HSAs are the main tax break for healthcare for many. What about India?
India uses Section 80D. This allows a deduction for health insurance premiums paid. For For yourself, spouse, and children, it's up to $25,000. Children, it's up to $25,000. If you pay for your parents, that's another $25,000.
And higher if they're senior citizens.
Exactly. The limits go up to $50,000 for senior citizens. There's even a small Euro 5,000 deduction allowed within these limits for preventative health checkups. It's very directly incentivizing buying health insurance policies.
Different approaches again. U.S. tax advantage savings account. India. Deduction for buying insurance. What about education costs? Student loans, tuition.
In the U.S., you can deduct student loan interest paid up to $2,500 per year. There are also tax credits like the American Opportunity Tax Credit, AOTC, which can reduce your tax bill by up to $2,500 per eligible student for tuition and fees, but these have income phase-outs.
So some help, but capped and potentially limited by income. India.
India's Section 80E is quite generous on this front. It allows a deduction for the entire interest paid on a loan taken for higher education for yourself, spouse, children, or even a student for whom you're a legal guardian.
Entire interest, no cap.
No upper limit on the interest amount itself. The deduction is available for up to 8 years, starting from the year you begin paying interest. That's a significant incentive.
That's huge for financing higher education. Okay, housing, mortgages, rent.
U.S. The main benefit is deducting mortgage interest if you itemize. It's deductible on home acquisition debt up to $750,000.
Still a significant deduction for homeowners.
It can be. In India, housing benefits are more varied, especially under the old regime. You can deduct home loan interest under Section 24B up to $2 lakh per year for a self-occupied property. The principal repayment part of your home loan can be claimed under that Section 80C umbrella we talked about within the 1.5 lakh limit.
And for renters.
India has the House Rent Allowance, HRA benefit. If you receive HRA as part of your salary and pay rent, a portion of the HRA is exempt from tax based on a formula involving your salary, the HRA received, and the actual rent paid. This is a major benefit for salaried renters in cities.
So again, India seems to have more specific levers for housing, covering interest, principal, and rent allowance.
Definitely more components under the Indian system, especially the old regime. Finally, just general investments.
Yeah, anything beyond retirement or housing.
In the U.S., there generally aren't broad deductions for just making investments unless you're itemizing certain investment-related expenses, which is uncommon for most. There are tax advantage structures like tax deferral on capital gains and retirement accounts, or specific things like 1031 exchanges for real estate, but not a simple deduction for putting money into stocks or bonds generally.
In India, we mentioned ADC covered some investment types.
Right, that 1.5 lakh Section 80C limit is the main vehicle. It includes equity-linked savings schemes, ELSS, which are tax-saving mutual funds, national savings certificates, NSC, public provident fund, PPF, and others. So India directly incentivizes certain types of financial investments via deductions within that overall cap.
Okay, summing up this whole deduction section, it sounds like India, particularly under its old regime, offers a much wider variety of specific deductions across savings, insurance, housing, education, allowing individuals to actively reduce taxable income in many ways.
Exactly. Sections 80C, 80D, 80E, HRA, home loan benefits, lots of options.
Whereas the U.S. system seems simpler on the surface, maybe. Fewer specific deductions available to everyone, relying more heavily on the larger standard deduction or structured, often employer-sponsored, plans like 401ks and HSAs.
That's a fair characterization. The U.S. often presents fewer, but sometimes higher limit options. It's more streamlined, perhaps, especially if you just take the standard deduction. India offers more granularity, more ways to engage with the tax system to find savings, but potentially more complexity in tracking everything.
Right, different philosophies in action.
Yeah.
Okay, let's shift to the practical side. Filing taxes. What are the key differences in just doing it, the nuts and bolts?
Sure. The core identifiers are different. In the USA, your tax identity number is your social security number, your SSN.
On in India.
It's the PAN, the permanent account number, essential for almost any financial transaction.
Okay. We mentioned the reporting forms employers give W-2 in the US, Form 16 in India. How about withholding? How does tax actually get taken out of your paycheck during the year?
In the U.S., withholding is based on the choices you make on Form W-4, which you give to your employer. You indicate your filing status, dependents, other adjustments. It tries to estimate your year-end liability.
So you have some control over how much is withheld.
You do. In India, the primary mechanism is TDS tax deducted at source. Your employer calculates and deducts tax based on your salary and any investment declarations you might make at the start of the year. It's often quite accurate for purely salaried individuals.
More automated, perhaps?
Can feel that way for standard salary income, yes. Now, if you have significant income outside your salary in either country,
Like freelancing or investments.
exactly, then you might need to pay taxes proactively during the year. In the US, these are called quarterly estimated tax payments.
In India.
They're called advance tax payments, also typically paid in installments throughout the financial year if your estimated tax liability exceeds a certain threshold.
And where do you actually file? Online portals.
Yes, both have official government portals. The US uses www.irs.gov for information and links to filing options.
Okay. And India's official portal is www.incometax.gov.in, where you can directly file your return. All right, practicalities covered. Identifiers, forms, withholding, self-assessment, portals. Now, the million-dollar question, or maybe the $10,000 question, depending on your income. What does this all mean for the taxpayer's bottom line? Who actually ends up paying more tax, and why does that difference matter?
This is really the crux of it, isn't it? And the answer is, it depends. But we can draw some clear patterns based on everything we discussed.
Let's quickly recap the biggest differentiating factors that influence that final tax bill.
Okay. Key differences at a glance. First, the deduction model. U.S. generally offers the choice, a high standard deduction or itemizing specific expenses. India, especially the old regime, gives a smaller standard deduction plus access to numerous specific deductions like ADC, ADD, HRA, etc. The new regime simplifies this, offering lower rates but removing most of those extra deductions.
Second.
The existence of optional tax regimes in India, old versus new, versus a single primary system in the U.S., though state taxes vary. Third, how healthcare is incentivized. U.S. uses tax-advantaged accounts like HSAs. India focuses on deductions for insurance premiums, ADD.
Okay.
Fourth, perquisites, those non-cash benefits, often tax-deferred or treated favorably in the U.S., but generally taxable as part of salary in India. And fifth, retirement contributions. U.S. generally allows higher contribution limits to plans like 401k, while India Section 80C has lower limits but covers a much broader range of savings and investments.
Got it. So with those differences in mind, let's paint a picture. What about someone earning a lower or middle income salary? Say, that software engineer comparing offers in Bangalore versus Silicon Valley.
Okay, for lower to middle income earners, India often comes out looking, well, significantly lighter on the tax burden.
Why is that?
Several reasons. India's basic exemption limit, 3 lakh, effectively 7 lakh tax-free under the new regime due to rebate, is actually quite generous when you consider the cost of living difference compared to the U.S.
Right. Purchasing power matters.
Absolutely. And then, especially if using the old regime or even with some limited deductions in the new, things like the standard deduction, maybe some ADC items, HRA, if applicable, they can dramatically reduce taxable income. You can realistically see people earning up to, say, 12 to 15 lakhs, that's maybe 14,000 to 18,000 US, paying very little, maybe even close to zero effective income tax if they plan well using the available deductions.
So our engineer earning, say, 10 lakhs, maybe around 12,000 US.
Could potentially pay almost no income tax in India with proper planning under the old regime, or very low tax under the new regime. Now, compare that to someone earning, say, $50,000 in the U.S. Even after the standard deduction, they're likely facing an effective federal tax rate of maybe 10–12%, plus state taxes on top of that.
That's a stark difference at that income level.
Yeah.
Okay, but does that trend hold as incomes rise? What about high earners?
That's where the picture can flip, or at least get much closer.
Yeah.
For high-income individuals, India's top marginal rates are actually higher.
Because of the surcharge and cess we talked about.
Exactly. That 30% top slab rate gets pushed up significantly by surcharges, which can go up to 37% of the tax amount for the very highest earners, and the 4% cess. The all-in top effective rate in India can hit that 42.74% mark.
And the U.S. top rate.
The top federal rate is 37%. No federal surcharge or cess.
BET.
State taxes again.
State taxes are the wild card. If you're a high earner in California paying 13.3% state tax on top of the 37% federal, your combined top marginal rate is over 50%.
Higher than India's top rate.
Potentially, yes. But if you're that same high earner living in Florida or Texas with zero state income tax, your top rate is just the 37% federal.
Which is lower than India's 42.74%.
Correct. So for very high earners, think incomes above 5 crore in India or over $1 million in the U.S., the total tax burden becomes highly dependent on the specific U.S. state. Could be comparable or higher in India or higher in a high-tax U.S. state.
So it really boils down to that fundamental difference in deduction philosophy again, doesn't it? That seems to be the most consistent theme. I think that's absolutely the core distinction in how the systems feel and operate for the individual taxpayer trying to manage their liability. In the US, unless you have specific circumstances that make itemizing worthwhile, like very high medical bills or state taxes or large charitable donations or mortgage interest, you take the large standard deduction. It's simpler for many, but offers fewer levers to pull proactively.
Fewer ways to actively reduce your tax bill through everyday financial choices.
Right. Whereas in India, particularly with the old regime, the system gives you numerous avenues. Section 80C for diverse savings and investments, 80D for health insurance, HRA for rent, Section 24B for home loan interest, 80E for education loan interest, MPS contributions. It's a much richer framework for tax planning through specific financial actions.
Almost like the system is nudging you constantly. Save here, insure yourself here, invest here.
It feels a bit like that, yes. It rewards engagement with these specific sections. So, wrapping it all up, India generally favors lower to middle income earners with lower effective tax rates, largely thanks to its exemption levels and that detailed deduction framework.
Especially if you utilize the old regime strategically.
Yes, the USA might offer lower effective tax burdens at very high income levels if you're in a low or no income tax state. But the fundamental difference remains. India's complex web of potential deductions versus the USA's more streamlined, standardized system, often anchored by the standard deduction or employer plans. Both encourage saving and investment, just through different tools and philosophies.
This has been incredibly insightful, really peeling back the layers on how the US and India approach taxing salaried income. Whether you're drawn to India's flexibility and numerous deductions or the relative simplicity of the US system, understanding these differences is just vital.
Absolutely. And, a final thought for you listening. If you are navigating either of these systems, remember that smart financial planning, especially preparing your tax documents, isn't just about chasing every last deduction blindly. It's about truly understanding the framework you're in, the rates, the standard versus itemized options in the US, the old versus new regime choice, and specific sections like 80C or 80D in India.
Knowing the rules of the game.
Exactly. Understand the nuances we've talked about today. Use that knowledge to strategically prepare your tax filings to ensure you're claiming the benefits you're entitled to and optimizing your situation within the legal framework. This deep dive hopefully gives you a solid foundation for that understanding.
All the best to you in your financial planning journey.
And we will meet again with another important subject in the next meeting.